Bitcoin just crashed below $67,000, down from about $79,000 just weeks ago. More than $11,000 vanished per coin. If someone had $100,000 in Bitcoin at the top, they would now have around $85,000, more than $15,000 gone. But here is what does not make sense. Bitcoin is collapsing, the price keeps dropping, and we are sitting just under $67,000, around $6,600 during Asian trading hours this morning. But institutional money is supposed to be the smart money. The Bitcoin ETFs were supposed to bring stability. They were supposed to be the foundation. Instead, they are bleeding. $6 billion in net outflows over the past months, nearly $1.9 billion year-to-date redemptions in 2026 alone. BlackRock CK dumped $435 million in a single week. Fidelity shed $109 million in one day. Does that make sense to you? Something is very wrong. By the end of this video, you will understand exactly what it is and why what happens in the next 48 hours could determine whether Bitcoin survives this crash or accelerates into something far worse. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. I show you the data they do not want you to see. I connect the dots they hope you miss. Subscribe right now, because this is the kind of analysis you will not find anywhere else. The mainstream financial media will not tell you what I'm about to show you. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Before we dive into the analysis, I need to make something very clear. This video is for educational and entertainment purposes only. It is not financial advice. It is not investment advice. It is not trading advice. I am not a licensed financial advisor or investment professional. I'm sharing my personal analysis and opinions about market patterns and data. Cryptocurrency investing involves substantial risk, including the risk of losing your entire investment. Past performance is not indicative of future results. Market conditions can and do change rapidly. Nothing I say in this video should be considered personalized financial advice or recommendation to buy, sell, or hold any asset. You should always conduct your own thorough research. Consider your personal financial situation, risk tolerance, and goals, and consult with licensed financial professionals before making any investment decisions. The predictions and scenarios I discuss are based on my interpretation of data and historical patterns. They are possibilities, not guarantees. I could be completely wrong. Got it? Good. Now let us dive into what is really happening. Let me walk you through the exact timeline of what just happened. On January 15, 2026, Bitcoin was trading at around $79,000. That was the local high. Institutional investors were confident. ETF inflows were strong. The narrative was bullish. Then everything changed. By February 5th, Bitcoin had crashed to about $67,000, and 11% to 13% single-day slide. The price erased weeks of gains and hours. By February 10th, we were sitting just under $67,000 during Asian trading hours. As I record this on February 11th, Bitcoin is struggling to hold the $67,000 level. That is a decline of roughly $12,000 per coin from the January high. In percentage terms, Bitcoin is down approximately 15% in less than 1 month. If someone had $100,000 in Bitcoin on January 15th at around $79,000, they would now have around $85,000. That is about $15,000 gone, vanished. But here's what I did not expect. I did not expect that while Bitcoin was crashing, institutional investors would be running for the exits faster than retail. I did not expect that the very institutions who were supposed to bring stability to crypto markets would be the ones amplifying the volatility. Let me show you what is actually happening behind the scenes. According to data from multiple sources, including AI Invest and Quora, U.S. spot Bitcoin ETFs recorded massive outflows throughout early February 2026. On February 5th alone, 6 of the 12 Bitcoin ETFs posted negative flows totaling $43,405 million in a single day. Not one ETF recorded inflows that session. BlackRock CK's iShares. Bitcoin Trust ticker IBIT led the exodus with $1,753 million in outflows. Fidelity's BTC followed with $109.48 million. Grayscale's BTC shed $1,742 million. Read that again. Let every word sink in. These are not crypto-native companies. These are Wall Street giants. BlackRock CK manages $10 trillion in assets globally. They're supposed to be long-term strategic investors, yet they are dumping Bitcoin faster than anyone else. Year-to-date data shows approximately $1.9 billion in net redemptions from Bitcoin ETFs in 2026. That comes after Bitcoin ETFs saw roughly $6 billion leave over recent months, according to Yahoo Finance reporting on February 1, 2026. The data from CryptoCoin supports this trend. The 12 Bitcoin spot ETFs have seen an outflow of approximately 4,595 BTC since the beginning of 2026. During the same period last year, these products attracted nearly 40,000 BTC. Pay attention because understanding this could help you avoid making a massive mistake. First, let me explain the concept of institutional money flow because most people do not understand this, and that misunderstanding is costing them money. There are two types of money in crypto markets, not one, two. The first is retail money. That is individual investors, people buying $100, $1,000, $10,000 of Bitcoin. They trade on Coinbase, Binance, Kraken. They hold coins in personal wallets or exchange accounts. This money is emotional. It panics easily. It buys tops and sells bottoms. The second is institutional money. That is pension funds, hedge funds, family offices, corporate treasuries. They do not trade directly on crypto exchanges. They buy through regulated financial products. In Bitcoin's case, that means the spot ETFs that launched in January 2024. These ETFs were supposed to be game changers. Here is why. When BlackRock, Fidelity, Invest, and other major asset managers launched spot Bitcoin ETFs, the narrative was clear. Institutions would finally have a regulated, easy way to gain Bitcoin exposure. No dealing with private keys, no custody headaches, no regulatory uncertainty. Just buy shares of an ETF the same way you buy shares of Apple or Tesla. The expectation was that institutional money would be smart money, long-term strategic, not reactive to short-term volatility. The belief was that ETFs would reduce Bitcoin's volatility because institutions would provide a stabilizing force. When retail panicked and sold, institutions would step in and buy the dip. That would create a floor under the price. But that is not what the data shows is happening right now. Now here is the critical point for understanding market dynamics. ETF flows are a real-time indicator of institutional sentiment. When money flows into ETFs, institutions are buying Bitcoin. When money flows out of ETFs, institutions are selling Bitcoin. It is that simple. And right now, the data clearly shows institutions are selling aggressively. This is not complicated. This is not some conspiracy. This is basic market mechanics that most retail investors completely ignore because no one explains it properly. Think of it like a season on a playground. On one side, you have retail investors. On the other side, you have institutional investors. For years, retail was the dominant force in crypto. When retail got excited, Bitcoin rallied. When retail got scared, Bitcoin crashed. But in 2024, institutions entered the market in a big way through ETFs. At their peak, these ETFs held approximately $137 billion in assets. They accumulated close to 7% of Bitcoin's total supply. That is massive. That is more Bitcoin than many entire countries hold. The question everyone is asking right now is this: if institutions are supposed to be smart money, why are they selling during this correction? And more importantly, what do they know that retail does not? Based on the data I have analyzed, this appears to not be a simple correction. The evidence suggests this is a structural shift in how institutions are viewing Bitcoin in the current macro environment. Consider what that means. Let me show you exactly what the data reveals. I'm going to present 7 pieces of evidence in sequence. Each one builds on the last. By the end, you will see the full picture. Evidence 1, U.S. Bureau of Labor Statistics, Washington, D.C., the United States government's official employment data agency, one of the most respected economic data sources in the world. On January 9, 2026, the BLS released the December 2025 jobs report. Here is what it showed. The U.S. economy added just 50,000 jobs in December. That was below the downwardly revised 56,000 from November and significantly below forecasts of 73,000. Even more striking, for the entire year of 2025, the average monthly job gain was just 49,000. Compare that to 2024's average of 168,000 jobs per month. That is a 708% decline year over year. The unemployment rate held at 4.4%. But here's the key detail. The BLS also announced that preliminary benchmark revisions pointed to a record downward adjustment of 911,000 jobs for the year through March 2025. Read that again. Let every word sink in. 911,000 jobs that we thought existed did not actually exist. They were revised away. The labor market is far weaker than anyone realized. Based on this data, this appears to not be a healthy economy with strong job growth. The evidence suggests this is an economy that is cooling rapidly, potentially heading toward recession. Evidence 2, Federal Reserve policy expectations, multiple sources. According to Reuters reporting on February 11, 2026, economists expect the January 2026 jobs report, due to be released today at 1:30 p.m. ET, will show approximately 70,000 new jobs added. That is a slight improvement from December's 50,000, but still historically weak. The key question is, what will the Federal Reserve do in response? Here is where it gets fascinating from a market analysis perspective. A weak jobs report typically signals the Fed should cut interest rates to stimulate the economy. Lower rates are historically bullish for risk assets like Bitcoin because they make borrowing cheaper and push investors toward higher return investments. But the data shows Bitcoin is falling even as rate cut expectations rise. According to Trading Economics, the market expects the Fed to maintain a dovish posture throughout 2026 due to labor market weakness. Why would Bitcoin fall when conditions appear favorable for rate cuts? The answer reveals something critical about market structure that most analysts are missing. Evidence 3. Bitcoin ETF institutional flow data, multiple providers according to BitBo data, covering the period from January 27th to February 6th, 2026. Here are the exact flows. January 27th, $10.52 million net outflow. January 28th, $15.2 million. January 29th, $381.1 million. January 30th, $672.5 million, the worst single day. February 2nd, $387.7 million, rare inflow day. February 4th, $63.4 million. February 5th, $282.5 million. February 6th, $79.6 million total for this period. Approximately $1,592.6 million in net outflows. That is about $1.66 billion, leaving Bitcoin ETFs in just 10 trading days. But the data gets more interesting. On February 10th, according to AI Invest, Bitcoin spot ETFs saw a $167 million net inflow, the third straight day of positive flows. That sounds bullish, right? But context matters. That $167 million inflow came after a prior week that saw $318 million in outflows. The three-day inflow total was $311.6 million, still not enough to offset the previous week's selling. Here is what Binance Square reported for February 11th. Spot Bitcoin ETFs added $166.6 million on Tuesday, February 10th, lifting total weekly inflows to $311.6 million. The pattern is clear. Institutions are selling into strength and only cautiously buying after severe drops. Evidence 4. CryptoQuant Whale Analysis, February 9th, 2026. And this is the part that really stands out in the data. According to CryptoQuant's head of research, Julio Moreno, the popular narrative that Bitcoin whales are engaged in massive reaccumulation is significantly overstated. Here's what he found. Much of the publicly shared whale accumulation data is distorted by exchange-related activity. Cryptocurrency exchanges routinely consolidate funds from many smaller wallets into fewer large wallets for operational and regulatory reasons. This artificially increases the number of wallets holding large balances, leading on-chain trackers to misclassify the activity as whale accumulation. When these exchange-related distortions are filtered out, the data shows large holders are still distributing Bitcoin rather than accumulating it. Marino stated, overall whale balances continue to decline. Holdings among addresses with 100 to 1,000 BTC are also falling, a trend that suggests ongoing exchange-traded fund outflows. But wait, there is a contradictory data point. Evidence 5, alternative whale data, Blockbaits via Binance, February 6th, 2026. According to Blockbeats and CryptoQuant analyst CW8900, on February 6th, approximately 66,40 bitcoins flowed into accumulation addresses that marked the largest single-day inflow since 2022. Additionally, new large-scale investors took advantage of the price drop by increasing purchases and transferring Bitcoin from exchanges to personal wallets. So, which is it? Are whales accumulating or distributing? And if you think that evidence is significant, wait until you see what technical analysts are revealing about support and resistance levels. Evidence 6, technical analysis data, multiple sources, February 2026. According to Blockhead analysis published February 9, 2026, Bitcoin is facing significant resistance in the $72,000 to $72,500 zone. This area coincides with the 61.8% Fibonacci retracement of the decline from around the $79,000 high to the $6,500 low. On the downside, the $65,000 level is identified as the principal support zone. A sustained move below this level would significantly weaken the short-term outlook. OneUp Trader's technical analysis from February 5th identifies $60,000 to $65,000 as the line in the sand. As long as BTC holds above this zone on a weekly closing basis, the long-term uptrend remains intact. If it breaks below, that would point to a much deeper change in market conditions. According to Daily Forex analysis from February 11th, Bitcoin dropped to the high $68,000 and is trading below the key support level around $74,000, its lowest level since April last year. The relative strength index has remained slightly above the oversold level of 30. The analysis concludes the most likely scenario is that the coin will continue falling potentially to the psychological level at $60,000. Evidence 7, Market Sentiment and Fear and Greed Index, February 2026. According to multiple sources including Moodrex and CoinStats, the Crypto Fear and Greed Index returned to extreme fear territory in early February with scores in the 20s to 30s range. The index has been between extreme fear and fear territory since early November 2025. Historically, since February 2018, the market has been in extreme fear or fear approximately 62% of the time. When the index reaches single digits or low double digits, Bitcoin has historically bounced from those lows within weeks or months. Drop a comment telling me, based on the data we have reviewed so far, do you think Bitcoin will hold the $65,000 support level or break below it? I read every single comment and I am genuinely curious about your analysis. Now let me show you an interesting pattern in the data. This is perhaps one of the most important parts of this analysis. Pay very close attention to what I am about to show you. Looking at the data, nearly all of the selling pressure this year has occurred during U.S. trading hours. When American institutions are active, we see Bitcoin drop. Red candles, aggressive selling. When Asian markets are active, Bitcoin often stabilizes or attempts to recover. On February 10th, CNBC reported that Bitcoin dropped as much as 2.8% to around 66,600 during Asian trading hours on Wednesday. But here's the key detail. Those declines came even as the MSCI Asia Pacific Index advanced 1.5% to an all-time high, extending its year-to-date outperformance over US and European peers. Read that carefully. Asian equities hit all-time highs. Bitcoin fell. That disconnect is significant. According to Money Control, Bitcoin fell to its lowest level since last Friday's sell-off, diverging sharply from Asian equities that climbed to fresh records and highlighting investors' lack of confidence in a sustained recovery. What we are observing in the data suggests that institutions in different regions may be taking different approaches. Some appear to be selling paper exposure through ETFs. These are primarily American institutions: BlackRock, CK, Fidelity, Grayscale. They are dumping ETF shares, which forces the ETF providers to sell the underlying Bitcoin to maintain proper backing. Meanwhile, data shows other regions are displaying different behavior. According to Pinto News analysis from February 4, 2026, Bitcoin whales have been actively accumulating the cryptocurrency during the recent price drop. Whales tend to capitalize on correction phases to gradually add to positions. One group seems to be trading on screens using regulated ETF wrappers to exit positions quickly. The other group appears to be accumulating physical Bitcoin, moving it off exchanges into cold storage wallets. This dynamic is not new. This pattern has appeared in market data for as long as I have been studying these markets. Historically, we have seen Western institutions trade paper, Eastern buyers accumulate physical, but right now, based on the data, it appears to be happening more aggressively than previous periods. Understanding these market dynamics is crucial for anyone studying crypto markets. If you understand how these patterns work historically, you can better interpret current market movements. Knowledge of market structure helps you avoid common mistakes that uninformed participants make, like selling into panic when data suggests accumulation is happening beneath the surface, or buying into strength when institutions are quietly exiting. Let me show you the bigger picture context, because what is happening today did not start today. This has been building for months. According to the Wall Street Journal and multiple financial sources, President Trump nominated Kevin Warsh to lead the Federal Reserve when Jerome Powell's term ends in May 2026. Markets view Warsh as hawkish, meaning he's likely to keep interest rates higher for longer to combat inflation. Treasury Secretary Scott Bessent signaled in February that the U.S. government would not step in to support the cryptocurrency market. That removed a key backstop that some investors were hoping for. Michael Burr, the investor who predicted the 2008 financial crisis, wrote in his Substack that Bitcoin has been exposed as a purely speculative asset and is not near the debasement trade hedge that gold and other precious metals are. He warned that a sustained decline in Bitcoin's price could set in motion a death spiral, leading to massive value destruction. Now, I do not agree with Burr's conclusion, but his statement reveals how traditional finance views Bitcoin right now, not as digital gold, not as an inflation hedge, but as a speculative risk asset that moves with tech stocks and other high-beta investments. From a structural analysis perspective, Bitcoin's correlation to Nasdaq and tech stocks has increased significantly. When tech sells off, Bitcoin sells off harder. When tech rallies, Bitcoin rallies harder. That is not the behavior of a safe haven asset. That is the behavior of a leveraged bet on risk appetite. This appears to not be a short-term issue that will resolve itself next week. The data suggests this is a structural dynamic that has been building since October 2025 and appears to be accelerating. Let me give you historical context. In late 2018, Bitcoin fell from approximately $6,000 to $3,200 as institutions pulled back during a macro risk-off environment. That was a 46.7% decline. It took 15 months for Bitcoin to recover to previous highs. In March 2020, Bitcoin crashed from $9,000 to $3,800 in a single day as CO panic triggered liquidations. That was a 57.8% decline, but it recovered within 3 months as the Fed announced unlimited quantitative easing. In May 2021, Bitcoin fell from $64,000 to $30,000 as China banned crypto mining. That was a 53.1% decline. It took 4 months to make new highs. I am not predicting we will see those exact scenarios repeat. Markets are different now. This is educational context only, but historically the fundamental dynamic has been consistent. When institutions de-risk and macro conditions deteriorate, Bitcoin falls harder and faster than most assets. When conditions stabilize and liquidity returns, Bitcoin often rallies harder than most assets. The question is, where are we in that cycle right now? Now let me walk you through what I believe could potentially happen next. Remember, these are possibilities, based on historical patterns and current data analysis, not guarantees or financial advice. Scenario 1, capitulation and recovery. My assessment, 50% probability. Based on historical pattern analysis, this could potentially play out similar to the March 2020 COVID crash or the May 2021 China ban crash. In this scenario, Bitcoin tests or breaks below the $65,000 support level. In the coming days or weeks, we might see a spike down to $60,000 to $62,000. That would represent a total decline of approximately 21% to 24% from the roughly $79,000 January high. At that level, historical data suggests forced liquidations would flush out remaining leveraged positions. Institutions would have completed their de-risking. The fear and greed index would likely hit single digits, indicating maximum fear. Then if macro conditions stabilize or the Fed signals more dovish policy, buying could return, ETF inflows could resume, Bitcoin could potentially recover back towards $75,000 to $80,000 by the end of Q2 2026. This scenario assumes the U.S. jobs report today shows continued weakness. The Fed maintains dovish guidance and no major negative catalysts emerge. Scenario 2, extended bear market. My assessment, 35% probability. Alternatively, if macro conditions continue to deteriorate, we could see a more extended correction similar to 2018. In this scenario, Bitcoin breaks below $60,000 and continues grinding lower over several months. We might test the $50,000 to $52,000 range identified by technical analysts as the next major support. ETF outflows continue. Institutions remain net sellers. Retail capitulates. The narrative shifts from Bitcoin is digital gold to Bitcoin was a bubble. Recovery would take quarters, not weeks. We might not see new highs until 2027. This would require the Fed to remain hawkish despite labor market weakness, inflation to remain sticky above 3%, and risk appetite to remain suppressed across all asset classes. Scenario 3, immediate recovery. My assessment, 15% probability. The third possibility is that the $65,000 to $67,000 level holds as strong support. Institutions finish their de-risking and buying returns quickly. In this scenario, the U.S. jobs report shows significant weakness. The Fed signals imminent rate cuts and risk appetite returns to markets. Bitcoin could potentially reclaim $72,000 within 2 to 3 weeks and make a run at new highs by late Q1 or early Q2 2026. This would likely mean ETF inflows resume strongly. Whale accumulation data becomes undeniable and retail FOMO returns. This is the least likely scenario based on current data, but it remains possible. Now, I want to share my personal analysis and what I am watching for. Again, this is my opinion based on pattern recognition, not financial advice. I could be completely wrong. This is for educational discussion only. Based on my analysis of historical patterns and current market structure, I believe Bitcoin could potentially test the $60,000 to $62,000 level within the next 7 to 14 days, especially if today's jobs report comes in weaker than expected and confirms the economic slowdown narrative. However, I also believe that level could represent a significant buying opportunity for those with long-term conviction, provided the $60,000 level holds on a weekly closing basis. This is not a guarantee. This is my interpretation of the data. Markets can and do behave unpredictably. I'm basing this on 3 specific data points. First, the technical support identified by multiple analysts in the $60,000 to $65,000 range. Second, the whale accumulation data from February 6th showing 666 40 BTC flowing into accumulation addresses. Third, the extreme fear readings and sentiment indicators which historically mark near-term bottoms. That said, I could be completely wrong. There are many variables I cannot predict. Geopolitical events, regulatory changes, unexpected macro shocks. Never make investment decisions based solely on anyone's predictions, including mine. Screenshot this if you want to hold me accountable, but remember, it is an educated guess, not a certainty. Which scenario do you think is most likely based on the data we have reviewed? Drop your analysis in the comments. I read every single one, and I am genuinely curious about other perspectives. Now let me walk through some educational considerations for different types of market participants. This is not personalized advice. Everyone's situation is unique. This is general educational content about how different participants historically approach these markets. For long-term physical holders, educational overview from an educational perspective, those holding physical Bitcoin for long-term wealth preservation typically approach it differently than traders. Physical Bitcoin in many investors' strategies functions as long-term savings or a hedge against monetary debasement. Just like someone would not sell their gold holdings because of a one-week price drop, physical Bitcoin holders often maintain positions through volatility. The educational principle: you do not have a realized loss until you sell. Until then, it is just a number on a screen. Historical data shows that patient holders who maintain positions through corrections have often been rewarded over multi-year timeframes. The 2018 bear market saw Bitcoin fall 84% from peak to trough. Those who held through that period and did not sell saw their positions multiply in value during the 2020-2021 bull run. However, the educational caveat is equally important. This approach requires the emotional fortitude to watch your portfolio decline significantly and the financial ability to not need those funds during the drawdown period. For those with leveraged positions, educational warning. From a risk management education standpoint, today's volatility illustrates why leverage in volatile markets carries extreme risk. The concept of liquidations triggering liquidations is well documented in crypto. When Bitcoin falls sharply, leverage long positions get liquidated. Those forced liquidations create selling pressure that pushes prices lower, triggering more liquidations. This creates a cascade effect. Educational principle. Even sophisticated traders with sound analysis can be stopped out by short-term volatility when using leverage. Market history shows that reducing or eliminating leverage during high volatility periods has protected many traders from catastrophic losses. According to data cited in this analysis, Bitcoin's open interest has fallen from over $95 billion last year to approximately $45 billion currently, showing significant deleveraging is already underway. For those considering entry educational framework from an educational market timing perspective, there's a principle often cited. The best time to consider buying is often when there is fear in the markets. The Crypto Fear and Greed Index is in extreme fear territory. Historically, some of Bitcoin's best buying opportunities have occurred when this index hits single digits or low double digits. However, the educational caveat is equally important. Never invest more than you can afford to hold through extended volatility. No one can perfectly time the bottom. Attempting to do so often results in buying too early and then capitulating when prices go lower. A common educational strategy is position averaging, sometimes called dollar cost averaging. Rather than going all in at once, building positions over time at different price points. If you believe Bitcoin will be higher in 3 to 5 years, but are unsure about the next 3 months, buying a small amount now, more if it falls to $62,000 and more if it falls to $58,000, reduces timing risk. This educational approach helps mitigate the risk of buying right before another leg. For those who bought recent highs, educational perspective. If someone bought Bitcoin between $75,000 and $79,000 in January 2026, from an educational standpoint, they face a decision framework. Option 1, sell and realize the loss, accepting the timing mistake. This makes sense if your thesis has changed or if you need the capital for other purposes. Option 2, hold through volatility and wait for potential recovery, accepting the drawdown risk. This makes sense if your long-term thesis remains intact and you do not need the capital. Educational context. Bad timing is not the same as a bad asset if the underlying fundamentals remain intact. Historical data shows that patience has often rewarded those who can emotionally handle the interim volatility. Bitcoin has experienced 7 major corrections of 30% or more since 2017. 6 of those 7 times it eventually made new all-time highs. The 7th is still playing out. However, past performance does not guarantee future results. Remember, these are educational frameworks, not personalized advice. Everyone must make decisions based on their own research, financial situation, risk tolerance, and consultation with professionals. Based on years of market observation, I have noticed 3 types of market participants during volatile periods. See which description resonates with your current approach. Type 1, the reactive participant. They see price movement and make immediate decisions based on emotion. They see Bitcoin at $67,000 and think it was $79,000 a month ago.